Adem's with us, and God, Adem made it to Trader Summit, so he's climbing in the world. Adem, welcome back to Face. How are you?
Hey, gentlemen, how are you doing this morning?
Good, Adem. Great
Hey,
to talk to
welcome.
you. Yeah,
It's good to hear from you, Dale and Blake and
yeah.
Stelios.
All right. So December, Adem, what's top of mind? Are you going to be sharing your screen? Go ahead and take over.
Yes. Let's see. There we go.
So I do remember maybe an interview or two ago that you were actually taking a spec position on long China. Has that been working out for you?
It didn't at first,
Right,
and then
it did.
bottoming, and now it is. And then the long bond play. When you were just talking, some other gentleman was saying how he was expecting uh, Powell to be more
Mean.
hawkish, yeah, in
Yeah.
that last meeting. But then that CPI number came in, and it's just those kind of black swans that I think really move the market because you have everyone was positioned for Fed to keep tightening, and then I think the TLT I
Oh,
got
you
lucky
take.
with it in October.
Oh, oh, the TLT. Yeah.
Yeah, I was
Uh,
just looking at the TLT some long. I was like buying the May call options. 103 strike. They were trading at like 12% implied. Really, I mean that's a really small uh, curve spread. Not to mention on the volatility smile, they were also really cheap. So I said, you know what? I think there's going to be some sort of slowdown next year, and I think bonds are going to rally. And I didn't know what would cause it. And then like 2 weeks later, that CPI came in, and it wasn't even that much less, right? It was like what 0.5 less than people are expecting. And then you
okay.
see the 10-year blow out, rates plunge, and then now everyone's like, oh, Fed's gonna probably be dovish until this recent you know employment data. But it just goes to show you how like these big moves, these big volatile moves are just getting bigger as markets are trying to price in things and reprice suddenly.
Okay. So what are you seeing asymmetrically, and what's the last book you read? And
Last
what are
book
you
I
showing us? What are you showing us on your screen anyway? What
Oh,
is
are
it?
you able to see this,
Yeah.
the BIS
No
report? I don't know
data.
if you saw it.
No, I see no data received from your website yet. That's what we're seeing.
Oh,
I don't
wait,
know
wait,
what you're
sorry,
showing, actually.
wait, you're not seeing my screen right now?
I'm seeing your screen, but I'm asking, what are you showing us? No,
Sorry. So I was actually looking at this yesterday. So the BIS, Bank of International Settlements, they
well, that's not
posted.
what we're looking at. We're looking at
Oh, wait, what do you see?
it keeps
Weird.
coming up, average engagement time, report snapshot,
What?
trader funding program. I don't know what you're
This
trying
isn't
to.
my. That's not my screen.
Well, are you sharing?
Yeah. Let me do
Okay,
it again.
same
Oh,
thing.
another participant says you cannot start screen while the other participant is sharing.
Oh, Blake's still sharing. Hey, Blake.
Oh, sorry about that. That was me.
Oh, no.
That was my fault.
All right. Thank you,
Is
Blake.
this?
Thank
Is
All
God you
right,
guys
there.
didn't see anything
There we.
crazy. Like,
Yeah.
wait a
But it
second.
was,
Was that the right screen? Joking.
right.
Yeah. Anyway,
Oh
yeah, it
God.
was pretty neutral, Blake. You're not in trouble.
No, I was
Anyway,
trying to look up some analytics and I
yeah.
couldn't have figured out. All right,
I'm
thanks.
going. What's the Dem showing this for?
Okay.
Anyway,
So
I
this right
figured
here.
Blake closed him on the trader funding program, and he
Yeah,
was
I
checking
was
it out.
yeah, I was kind of I was gonna say like, I'm not sure what you're
All
looking
right.
at, but all right, so okay, so yeah, there's this, I
Oh
don't know if
yeah,
you
we were
heard
talking
yesterday.
about this morning.
Yeah, so
All right, go ahead.
and this is something you and me talked about like a year ago, 2021, and the BIS now is saying how there's obviously a massive blind spot in the FX swap market. And so if you already went into detail with everyone, basically in
No,
FX.
go ahead. No, I want to
So,
hear.
so I was going to say individuals don't know, like foreigners, like European, let's say a Swiss pension fund or something. They want to buy U.S. equities, bonds, whatever. They swap currencies usually, they give XYZ euros to the bank, then they get the dollars instead, then they buy the US assets, and then at the end of the term, they swap back. Now, the profits are usually made if when they buy those, when they get those dollars in return, if the dollar goes up, I'm sorry, if the dollar weakens and whatever asset they bought with those dollars, it's usually bonds or equities, it appreciates. So then the Swiss fund will sell the dollar assets and etc., and then end up trading it back, and they make their profit or gain on the increasing asset and also on the yield. And also when they have to buy the euro back, I'm sorry, when they swap the currencies back, the US is cheaper dollar. But we've seen the opposite over the last year. Obviously, the US dollar has exploded, US assets have fallen. So individuals who have done swaps, and we've seen this Swiss National Bank, they've been, you know, gobbling up US dollars and over the swap line. And the Fed's tried to ease this with like the foreign lending market, meaning basically a repo for foreigners. And there's a huge safe asset.
Was that what they
like
did with Credit Suisse, Adem?
Oh yeah, and then China's been doing it off books.
Yeah. Okay.
Yeah.
Right.
They've all been doing it. China's been doing it. I mean, they've all like I wouldn't. I mean, it's such a huge market. Like these are off balance sheet obligations, and they were looking into it, and they said like a lot of these companies, analysts, it was something like 12 times capital. You know, double bank balance sheets. These FX swaps, and the thing is, these aren't notional like you know, like bond spreads, you know, how they're kind of hedged with the asset of the bond. I mean, these are currency swaps. So any big move can really, you know, who knows? Like, I mean, it's just such a massive market. And I think it just goes to show you that there's been a map here. Actually, I have a chart from the BIS site that was showing it. Yeah, like if you look at these, most of them mature. Almost 65 trillion of this matures in less than 1 year. I mean, that's the dollar being this strong is really acting like a wrecking ball in some of these. And we've seen it, you know, throughout the economy, like you were just saying, the Swiss National Bank, and we've seen China, we've seen countries just Britain when they were.
Credit Suisse is not a national bank. They're a bank, and they were, you know, people were talking about them possibly being able to fail. So the Fed did some swap lines with them. Is that related to this?
Oh, I'm sure it is. Because I mean, when they get those dollars, they give it to their banks, right? I mean, they're being like, yeah, you know, they kind of have their own little like pyramid of banks. And it just goes to show you how outside the US, like outside dollar creation, it can really run rampant. And I think the bigger problem here is that there's a structural imbalance in the world economy right now when you're seeing there's basically a safe asset shortage. There's a bond shortage in the world and a US dollar shortage. And I know a lot of people say like, well, how is there, you know, a dollar shortage? How is there any kind of capital shortage? And when I say dollar shortage or savings glut, you know, more informally, it's not that everybody's like loaded with money. It's that so you have countries in the world who continually run current account surpluses. And just to put an example, everyone's showing here's China's capital account or current account. It's back at 1.5 trillion, as you can see. That's a massive imbalance in their economy. And you can see between 2008 right here, it peaked, and then it started declining as their economy was consuming more. So their consumptions were rising, their imports were increasing, their exports were, you know, they weren't such an export heavy economy anymore. Well, 2020 happens, they're back to running all-time high current account surpluses. And yeah, a lot of it's to do with their demand weakening, but
that last peak was right around the financial crisis.
Yep, exactly.
Right. And
yeah, it was.
With it coming down for years into 2020, was China doing okay and supporting the global economy, right?
Yep. And they were importing everybody's excess.
Now we're in the opposite direction.
Now we're in the opposite, and this is kind of the problem. Is that, and Michael Pettis? So you asked about a book. There's there's this book. It's kind of old, but I always go back and read it. I actually just reread it. It's called The Volatility Machine, and he wrote it in like 2004, and it's about emerging markets and dollar shortage and how,
Oh, he saw it coming.
yeah, he's a brilliant guy. And he also has a recent book he published. I know I've recommended it a couple times, Trade Wars or Class Wars. But
Well,
so basically,
Dario yesterday said the reverse currency wars are over. Do you agree?
the reverse currency wars.
Yeah, that's what he said. Or the
Yeah.
currency wars, and now we're in the reverse of it. I believe that's what he labeled it. Yeah,
Well,
it's reverse.
it'll be hard to tell because I mean I could see it. It's definitely not like how it was after '08 because the dollar was weakening back then. I think the Dixie hit like in the mid 60s back after 2008 at some point, and 2009. And when the US dollar was weakening, every other currency was inflated. I mean, the Canadian dollar was over $1 power to it hit par with, it was a higher. The euro was what, like 150. So yeah, I could see there being a currency war then. Obviously, everybody was floundering, trying to undercut each other to get kind of an advantage. And
so the contrarian trade now, after about 2 months or so of the dollar pulling back, it seems like it's pretty crowded now on the short dollar side.
oh yeah, I mean it's usually how. I mean, we always see this
That
happen.
happened quickly.
It does happen quickly.
90% bulls in the dollar when it was 114, above 114, and now we're in the 30s or 40s. It's at least neutral now.
Yep. Yeah, you have all them.
Do you think this 104 is going to hold in the Dixie, Adem, or
it could go lower in the medium term, but I think longer term dollar's going to keep going higher unless the Fed really does something. I mean, even with their easing, even with all their stimulus in 2020, I don't think we saw it drop below 90 or like 89, and that's still pretty strong relative to the other currencies. So I don't know. I think dollar's going to go higher just because, like we were saying, when you have countries like China, like right now, the current account surplus high. Germany, before the energy crunch, was the world's leading current account surplus country. And then there's Japan, the Netherlands, Saudi Arabia, Russia. You have all these countries that basically have structurally built their economies. It's kind of like instead of a reverse currency war, I'd call it like mercantilism via currency manipulation, because you have these countries. So instead of doing like tariffs and quotas to discourage imports and boost exports like China does, you have China simply holding down the value of their currency. They suppress investment returns. They subsidize exporters. I was looking at the recent CSIS report, and it showed how basically all of China's capital goods market, which is one of their largest exporters, they're one of the largest exporters of capital goods in the world. It's like 45% subsidized by the government. They do this on purpose, and all these countries do. Japan does it too. They have built their economies around trying to be export heavy, and it works in the short term when you're trying to get growth, like we saw up to 2008 for their economy. I mean, they had rapid gains back then, but obviously you run into the law of diminishing returns. But this creates two issues, because the US dollar is the reserve currency. So any extra demand for dollar assets has to be matched with supply, right? So America has to create that supply. So when all these countries are exporting more than they're importing, they get those dollars and they want to send it back because they don't want to just sit on dollars. They want bonds. They want yield on it, right? So America has to oblige. And the problem with it is they suppress domestic demand in their economies, because if they weren't, they wouldn't be exporting as much if they were consuming what they made. And someone has to be forced to absorb the excess exports and the excess savings. Otherwise, a recession will happen. Unemployment will rise, because if America says, hey, we're going to stop running big deficits and whatever, and if China, you're not consuming it, then unemployment must go up. I mean, how else is it going to work then if there's no demand? So the key reason for this cause and this global savings glut is that the world is continually growing with savers and demand for low risk bonds. I was reading Adem Turner's book, Between Debt and Devil, and he shows, and he used to work for like the BOE, I think, and he basically shows that credit has been expanding, like I think at like 15% per year on average for the last like 50 years.
Wow.
40 years, where growth has been falling. So when you have credit expanding more than GDP or growth, you build up a savings glut. And these companies, everybody, there's so much demand for low risk investments, and bankers are getting creative. You know, you see mortgage-backed securities, auto-backed securities, collateralized loan obligations, etc. And it's just that since the late 90s, that's what really kicked off this whole thing, because after the Asian contagion, which I should note happened after the Bill Clinton surpluses. So it just kind of goes to show you that when America is not absorbing the glut of goods abroad, it creates instability because it puts less bonds, it puts less dollars out into the world economy, and the economies who need it become starved. So all these countries started building their economies around funding themselves with exports. And now, it's, the excess savings plus demand has kept the US dollar overvalued, which has kept investment returns down, yields lower. And it's facilitated a surge in US debt because debt is so cheap because it keeps flooding into America. The Fed doesn't even have to ease. This is what I've argued before. Like if you look at the natural interest rate, it's gone down. Even if the Fed didn't cut market rates lower, natural interest rates over the last 40 years have declined. I think the natural interest rate up to 2020 was like barely 1%. So if the Fed has to get growth, they have to force market rates below the natural rate. And for anyone interested in the natural rate, it's just Newt Wicksell, an old economist from the late 1800s. He basically said, like, without a central bank, there's still going to be interest, right? Like there is always going to be interest. Banks do it, investors do it. And he said, so usually it's determined by like inflation, growth, demographics, like a quantifiable how the economy is doing, because demographics plus productivity equal growth. And he said, if both are falling, you're going to have a natural rate decline because there'll be more savings built up, and investors or whatever's just trying to get it out into the economy. So rates are going to like drop. And we've seen the natural rate drop. So the theory is if the Fed wants to stimulate the economy, they will be forced to cut market rates at the short end below the natural end. And Edward Chancellor
negative rates again.
Exactly. And Edward Chancellor, for anyone interested, this is an important topic. He wrote a book recently. It's Edward.
You know why? After you talk about this book, we're in December. I know you're a thinker, and you're thinking, 2022 is almost in the books. What are the opportunities coming up in 2023 that I'm looking to build a campaign position on? Maybe you could share that with us, Adem. What you think your big ideas coming up for 2023.
So I'll get right to that. So anyone interested in this natural interest rate versus market rates and how the Fed intervenes, Chancellor wrote this book like 3 months ago.
Oh yeah, I like the hourglass.
Right. And I don't want to like shamelessly.
My favorite TV show, as the sands in the hourglass, so are the days of our lives.
Yeah, it is a good picture. I'm not familiar with that, but
well, you didn't want. Well, I guess you don't watch soap operas anyway. The market can be a soap opera, or the people you deal with when you're in the market can be a soap opera. So
yeah, I agree. So by trade stuff, before I said that, anyone interested in like how market rates and Fed cuts and natural interest rate of interest, the theory is that as natural rates have declined, the Fed's been stuck between a rock and a hard spot, mainly because savings are building up, the production slowing down, aging demographics, etc. Total factor productivity is down everywhere, law of diminishing returns, etc. So, and not to mention entitlement spending has ballooned. And how can you have entitlement spending ballooning while growth slowing? That's not sustainable. So the Fed has basically stepped in, cutting rates constantly below the natural rate to try to like kickstart something. But the side effect of it is vicious asset bubbles. So, they're kind of stuck. But so regarding trades, I was actually looking at this thing for trades. So every time the Fed or the yield curve inverts, and we all know the yield curve is the entire yield curve at this point is inverted. I do like bonds. Oh, what the hell is this?
Okay.
Yeah, I do like bonds. I think it's good for anyone looking or can see. This is the yield curve in 2020 and 2021. And
Okay.
this is the yield curve today. It's completely upside down. So I don't think that's going to get better anytime soon. I still think long yields are going to go lower if the Fed keeps tightening the short term, which I plan they will do for the foreseeable future. They're going to probably keep tightening the short end, even if it's at a slower pace. It's still increasing it. And I think but the economy at the longer end of the curve is pricing in deflation and recession. I know you talked about it last June when I was on here. I said I thought inflation peaked in June just because all the leading commodities and indicators were plunging. So I would be surprised if we see inflation growth pick up from here. Obviously, I'm not going to rule it out because oil and food are kind of the wild cards. Like there's shortages all over, affecting those markets. But
okay, so
I
you
think,
like so TLT, even though we've rallied pretty good, what about 13?
Yeah, I think on pullbacks
candles?
on TLT, I think discretionary spending is going to be bad. I think autos, used car prices, like I'm definitely not looking into 2023. Like there's some things I'm looking at, like Best Buy. I mean, I was looking at their recent thing. Their growth was terrible, and we always see a boost at like Q3 and 4, holiday spending, etc. So like I see people like, oh, like credit card usage was up and all this amount, not even fixed for inflation. But to me,
so bearish retailers, another big idea for 2023.
Yeah, I mean, if anyone's looked at
recession plays, what
I do think it's until the Fed stops. I mean, it doesn't. I mean, who knows? I mean, some say you can't have a recession with unemployment like this, and that's true. But we're kind of seeing a white collar recession happening right now. I mean, there's been layoffs across all of Silicon Valley, right? We saw Twitter, we saw Stripe Capital, we saw Facebook, right? Like we saw all these big, and a lot of people. Oh, the mortgage writing industry is killed.
They're gone. They're fired.
Yeah, and a lot. And a little, when I talk to
refis,
mortgage brokers,
no refis at
right?
6%. Yeah.
And the problem with it is these are the marginally high paying jobs, right? I mean, like someone losing a job in Silicon Valley making 175 to 125, 175 a year, losing a job. I mean, it's pretty significant when it's happening in waves. And there's this website called Daily Job Cuts. Anyone can check it out. Basically, it just shows companies that are hiring and planning on firing. Every time I look at it every day, there's just 3,500, 10,000, 20% of workforce. So I don't know. I think the leading indicators, so the Fed looks at the non-farm payroll, but if you look at the household survey, if you look at NFIB, they're all down. They're all like showing small business surveys. Like a small business survey show like they're cutting prices. I guess input prices are falling also too, but at the same time, like, they're not expanding. They're like at their worst expansion rate in like 40-year low or something, small business, which makes up about 45% of US business. So I wouldn't be surprised if we keep seeing it worse in in 2023, especially if the Fed tightens. So I think, things like discretionary spending, I think used cars is creating a problem. I think companies that hold a lot of used cars, and I know it's a pretty illiquid market. And what I mean by illiquid,
people are walking away from their $1,000 a month car payments now.
See, that's what I was telling.
It's almost as much as their mortgage payment at a 3% mortgage.
Yeah, no, I mean, it doesn't make sense. And like, I was talking to this guy recently, and I was telling him, like, there's an illiquidity pocket forming in housing and autos, and he's like, what do you mean? Like prices are just too high? And I'm like, yeah, but that's what illiquidity means. It means that there's such a large gap between buyer and seller that the volumes are down, and one of them has to budge, right? I mean, you're a stock trader. If the bid and the ask are way too far apart, you're going to see volatile swings if someone makes a move. But if no one makes a move,
trade it.
Exactly, and no one trades it. So when I see people, when they say like housing volumes are down, 36% year over year, but the prices aren't moving that low. And I'm like, well, yeah, give it time, because either the buyers are going to come back in and pay those prices, or the other sellers, which we're starting to see, are starting to cut like prices to get out. And who knows? I mean, but yeah, I think cars, and I think the big play on cars and I did this once in the past. I got burned on it, but at the same time, I just don't like companies like Avis Budget Group, big rental companies that have these huge fleet of used cars. A lot of people don't know they usually get their cars, they rent them, and then they sell them wholesale in the used car markets. So, but the thing is, if your used car prices decline rapidly, that's a huge write-off, especially on your market valuation. So that's your main asset base. So, especially if we see yields higher and car demand, new vehicle demand declines. So I don't know. I've been looking at those like puts. There's also some other little companies. Like I was looking at Wingstop. There's the wing place. Their stock is just, I don't know what it is about it, but it is. Let's check it real quick. It is extremely expensive. That's PE 112 PE ratio, right? Like it is. It makes no sense. They hardly make any money. Like people, for people knowing, that means people are paying 112 times their earnings. And the assumption is that their price is, that their earnings, since it's a ratio, is going to explode apparently significantly to make this price be justified. Like I say, earnings double, then the PE will drop in half, but I don't see their earnings doubling. I've seen some people say it's going to triple, and I just don't see it. So I've seen like 3 of them shut down by me anyway. So these are just some ideas.
They're great ideas, Adem. And so, my takeaway from our discussion is, you like bonds, TLT, maybe we'll get some kind of pullback into the Fed, you get long bonds, and that there's still, even with, say, the bond market performing, can occur with the stock market not performing in certain sectors because of economic weakness.
Oh yeah, I agree. I think bonds long term.
Well, I hope you agree. That's what I think you told me.
Yeah, I do agree.
Right?
And I think and I think bonds. I think bonds. Anytime you can, I think bonds globally are going to just keep going lower and lower, like demographics, diminishing returns. So I think anytime you can take advantage and get some lock in some long term yields or whatever you want, that's good. And not to mention, last chart before I know we're out of time. The net percentage of domestic banks that are now tightening standards has soared. It's at 40% now in Q2. That's a huge jump. So this usually follows yield inversion. Actually, 2018, same thing. Yield curve inverted, but it was like barely inverted. And we saw bank tightening, 2019, it shot up in Q1. This is before the September squeeze. And we saw banks start curtailing credit. And I think it's an important indicator because it's showing that banks now are getting on the long end. They're like, hey, even though we are loaded with deposits, it's,
credit
quality, everything is declining. So when you have banks start declining credit quality, they're not pumping out loans. That declines money velocity and money creation. And I just don't see how you're going to get more inflation at this point when you have everything kind of turning south.
Thank you at Radical Adem. We're another great presentation. You want to show your website? Been doing
check me on
you've
Twitter.
Expanded since F.A.C.E launched you on a rocket ship to your destiny into outer space.
Yeah, I'm very grateful for you guys at Space and everything. It's definitely been a pleasure speaking with you and catching up. And I hope to talk again, man.
Nice website. I went there. Real nice articles, Adem. If you like big macro thinking, Dem's your man. So check out his website, speculatorsAnonymous.com, and you could find him on Twitter at Radical Adem. And what's radical about him is that he works hard and he's not lazy, and he is has a voracious appetite for knowledge. So
you flatter me. Thanks, Dale.
Yeah, so really appreciate it. Hope you have a great holiday season, Adem, and we all root for you here. And thank you for bringing your insights to F.A.C.E.
Yeah, anytime, Dale, and same to you. Hope you guys all have a good holiday.
Okay, my trading warrior brother, Adem Tumerkan. So thank you, Adem. Have a great holiday season. Appreciate it, brother. My
great. Thanks,
trading warrior
everyone.
brother. Okay, and could join the team in 13 minutes on the morning edge where you get to see the bias charts, etc. And I'll see everyone tomorrow. Good hunting today, and don't just count your pips, count your blessings. You're welcome, Laura, Bhavana. See all you guys tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.